Hey guys, my name is Dante, and in today's video, I'm actually going to go over a trade that was the subject of a lot of buzz because it was a trade that we engineered that was going to make money no matter which way the SPY broke out of. And we made this trade last year, and a few of our friends and I were talking, and they told me I want to capture the S&P 500, the up move, and that's the last thing we want to miss. Is like we never want to miss an up move. In the same respect, if it free falls, because it was in an area kind of in the middle of a range, we want to capture that money as well. So again, we're trading with the end goal in mind. So for this specific purpose, we're trying to outperform the S&P 500 and capture at least a 15% year over year return. So that was the parameters for a trade like this. So with that being said, what I ended up coming up with was to sell the 300 put and to buy the 269 put to protect that 300 put, to then buy the 283 call and to also buy the 263 put. So when we created this trade, it was pretty ingenious for what it was worth, and so then when I first told my friends about it, I was like, okay, so this is what we're trying to capture. And it all happened fairly quickly. I was like, this is what we're trying to capture. This is what we're going to do. So they were obviously very, very puzzled by a trade like this. It's not an iron condor. It's not anything like that. So again, this is why I'm a big proponent and believer of supply and demand and then learning options. Because once you know those two, you can kind of create whatever you want based on the goal you're trying to accomplish. So this is not the kind of trade that you want to put on if you're trying to make, a 300% year in account size, or at least, it's not really intended for that. It's intended specifically to make money no matter how the trade breaks out both ways. So from what I understand, when we shared that trade, it was so fascinating, or when we came up with the trade, or when I came up with the trade, it was so fascinating that it was kind of shared thereafter, and it left a lot of people very, very puzzled. So with that being said, I'm going to go ahead and show you guys how I come up with the trade, why I came up with these specific numbers, and how the trade actually ended up working out in the second half of the video. So for that, I had to use Thinkorswim on demand so I can go back in time and then recreate the whole thing as if I was doing it all over again. So this is going to be a Thinkorswim kind of tutorial as well, but not really. But it'll be done on that platform. So without further ado, I hope this video you guys find helpful. You do not need to put on a trade like this to make a lot of money in the financial markets. So let me be clear on that. So something like this is something that I came up with for a very, very specifically requested parameters. You can make a lot of money trading options without having to come up with something this complex. So with that being said, I'm going to go ahead and walk you guys through the platform and kind of show you guys what I was thinking during this time. So at this time, it was around April of 2018. So I went back in time on demand on the S&P 500 or on Thinkorswim, and we are now looking at the trade for the day. So this is kind of what we're looking at that time. So the first thing, I asked my friend was because my opinion, I was very, very bullish on the S&P 500, and we kind of differed on that. So I was like, what is it that you're trying to accomplish here? Like, which way do you think is going to go first? Do you think it's going to go up? So rally first to like a supply area and then fall, or fall and then rally? And then he was like, or we were like, they couldn't really kind of determine that. So I was like, okay, so the first thing I'm going to do is, we know the S&P is currently trading at 265. And so the high was 286. So the S&P 500 always outperforms, not always, but over the course of 5 years, historically, only 5% of money managers have outperformed the S&P 500 for longer than 5 years. So the biggest thing in money management or anything like that is you don't want to miss the up moves, right? Because you don't want to miss the opportunity cost. And that's kind of how we pair rewards, right? Or how well a money manager did. Really, in my opinion, can they outperform the S&P 500 or not? because otherwise you're better off buying the ETF. So with that being said, I was like, okay, so what we're gonna do first is, because we know we're gonna be buying calls and puts, we want to be able to sell something so that we can borrow, or so that we can have some money coming in to offset some of the cost of buying those calls and puts. Because as you know, with the sliders or with trading, the very, very small differences or very small costs, can make a compound impact. So we went out at least 3 months ahead. And so most people at this point would be like, how can you possibly, why would anybody sell a 300 put? That is way above target. It's way above supply. Like, why would anybody do that? You don't sell puts in the money. You sell them usually in, below demand, right? So again, this is something where you have to be very, very clear on what your goals are and your expectations and your account size. So the risk with selling a put in the money is that you can get a sign at any given time. But what no one really takes into consideration, and again, this is a very specific way of trading, and you cannot do it on just any time frame. So please do not sell in the money or deep in the money puts if you don't know what you're doing, especially regarding your time frames. That's because that's the biggest thing, and that's where you can get killed. But for this purpose, the reason why we sold a 300 put, and the reason why it wasn't crazy, and why I don't understand why more people who are really good at price action don't do this, is because current price is 265, and this is we are on April 27th. So current price right now is 265. So selling the 300 put for the SPY gives us a $34 credit. So what is 300 minus $34? That would be about 266. When we did this trade, our break even was actually about $2 below current price. So essentially we got $2 for free. Now this doesn't reflect that, maybe because I'm going backwards in time, but I'll do a video in present time to show you guys kind of how that works. But so with that being said, we're gonna sell the 300 put. So again, selling the 300 put, I'm always going to try to get the maximum possible amount when I'm selling a put. Now, this for this example, even in this present time, the break even for this becomes the current price. So you're essentially getting paid up front for an up move. Now, the downside is obviously being assigned. So like I said, when we actually took this trade, the credit was about $2. The credit was about $2 below what the current price was at the time. So essentially we got $2 for free if we wanted to control it from that point. So with that being said, our maximum, our risk was then for if the SPY goes from 300 to 0 minus credit. And minus credit at this time was, at this current time right now, was, so right now it's 34.39 and price is 265. So 93, so 266. So in this specific example, current price or the break even is at least still below from current price, which means we're getting some free money minus commissions, all things being considered. So when we actually put on the trade, we're getting about $2 for free, meaning the break-even price after credit was $2 below the price it was at the time. So with that being said, the maximum free fall, if the most you can lose on a trade just like this naked, is if the SPY goes to 0. So 300 minus credit to 0 is the maximum loss. So we obviously couldn't leave ourselves to that much exposure. So what we then did was, we want to limit our losses. So we want to capture the up move, the entire up move, and we want to limit the loss. And so with that, I was like, okay, so if our break even for when we took the trade was when we took the trade, the break even was like 267. I want you to be able to do this even if you cannot do mental math that quickly. So I'm just going to go ahead and go to the analyze and add simulated trade, SPY, SPY. So again, we're going to go to August of 2018. And again, we're going to do the selling 300 put. And risk profile. So as you can see here, selling the 300 put gives us a break even at 265.69. And it is currently trading at 266.05. So now you can kind of see now where we're getting that free dollar, free $2. So with that being said, if the most we can lose so far in this trade is, go back to analyze. So far in this trade, the most we can lose is from 265. That's our break-even point. So if you were to do 100 shares, the most you can lose is roughly $26,500, right? So obviously we can't have that, especially if we want to limit our losses to no more than 5% at any given time. So back to trading, I went ahead and said, well, let's buy the 269 put. Okay, so now we're selling the 300, buying the 269 put. And so the reason we did this first was if the SPY went up first, you would close out. So let's say it went from 269 to like the, let's say supply at, so if it went from 269 to let's say 271 first, you would close out the 300 put first. Why? Because that's the biggest risk. And so basically these two were married. So if you couldn't close out the 269 without first closing the 300, so they were married to each other. They were contingent. You couldn't close 269 until you close 300. So it had to go up first for this trade alone, just like this, to work. So the second part was, well, what if it goes up first and then falls? And I was like, okay, so if it goes up first and then falls, I'm sorry, that was the first part. So if that happens, then we're going to sell the 300 put. We're going to buy to close it. So when you buy to close the 300 put, the credit will be a lot lower if price went up. So again, you couldn't close the 269 put or sell it without first buying to close the 300 put. So just because you buy a 300 put does not mean you have to hold it to expiration, one. And two, the reason I did 300 and now 280 is because you can always, if you let this expire or run its whole course and, you know, SPY goes to 295, you can always buy it to close for 500 and you still keep the other, you know, $1,900 of credit. Now, if it goes from 300 to 320, you miss the entire up move. So you can always buy to close for a little bit of you know, paying a little bit to buy it to close. But if it goes above the price, the strike price, then you're going to miss that up move. So that's why I chose 300. Now, if it fell first, what we had to do now is we could have bought two of these 269 puts, but then that would be too expensive. It would offset the trade. It would offset everything. So I was like, well, if you still believe demand might be, you know, 257 or 250, we can buy a put that is currently cheaper than at the moment because it might be moving in an uptrend right now. So if we go back to the options chain, what put would make sense between, and again, this is what we're trading. So price action or supply and demand is the leading indicator. So now we are leading, we're doing almost like a 2 times or 3 times leading price action, because now we're forward projecting what we're going to do based on what happens first from what price action is doing. So now I said, well, if it falls first, you cannot release the 269 put because that's married to the 300 put. So we're going to buy then another put that is between current price and where you believe demand to be. So if that is 250, the next put we buy has to be above 250, and it has to be a price that makes sense to add to this trade so that it doesn't get all messed up in terms of risk reward and P&L. So we're going to go back to the options chain. At this point, it's okay if you're puzzled. Again, I want you to conceptually understand this, not necessarily try to do it yourself. Now, well, if price goes down, and again, now we're leading indicators. If price goes down first, the 300 put will be losing about dollar for dollar upon assignment on the down move. So if it goes down first, meanwhile the 263 will be capped. The 269 will be eating the losses of the 300 put, and there's a gap there of about $2. So depending on how quick the move happens and how you want to calculate risk, the maximum risk so far is about $2 on this trade. So, and again, there's a few ways to calculate that. So I'm not going to make a video on that, but or maybe I will, but so far the trade for this is about $2, the risk, that in question mark, the unknown risk, I should say. So if the SPY falls first, this is gonna be going down dollar for dollar, but the 269 will be eating the loss of the 300. So if it comes down to demand at 250, then the 263 put will be now worth no less than $13 plus time, plus whatever time accumulation. The thing is, when price falls, the puts usually tend to end up making money faster because of the volatility rise. So we're gonna be able to so when we close it, if we close it before it's due, as it's free falling to demand, it's going to be worth that much more in extrinsic value. So now, what if SPY falls from here and then goes back up? At some point, you're going to want to close the 269 put, because then that one's going to start to lose a lot of money. So if it drops, so let's look at price action. So if it drops in basis here, and let's say, which is actually what happened, I think it dropped in base like at around 259 or so, in which point I was like, close the 263, because that one is now in profit. But it had gone up first in real life. But so far, I'm going to pretend I don't know that. So it's like close to 263, and hold on to the 269, as that one is the anchor, like kind of the risk anchor to the 300 put. Now, the markets are going to obviously fall and rise and fall and rise and fall and rise, right? So they don't stay static. So then, because here price was falling, what I now then knew that I asked, what is supply? And the goal is to beat the S&P 500. So far, we just have a trade that will make money, both ways, but primarily on the downside. But the end goal for putting on this trade was to never let the S&P beat us. So then I was like, well, now we'll buy a call out of the money, because they're so cheap, but it's got to be within supply. And the reason we're going to do that is because if the market just keeps on going and going and going and going, we don't want to close the 300 put and then miss the up move, because the 300 put was going to be closed upon the first supply level, but we still needed something that'll capture the entire up move of the SPY. So that's where we came up buying the 283 call, because at the time we bought it, it was super cheap because price was kind of diddling in the middle. So again, this is a trade that we put on whenever the SPY was neither in supply or demand, but we wanted to capture a move. We wanted to capture and make the move no matter what broke, no matter how it went. If it broke up or down first, we were going to make money on it, and we did. Now, this is going to be the executive summary. So this is, again, we have supply and demand that's a leading indicator, and then this is 2 times leading indicator. This is so we're in the middle of nowhere, but we want to be in a position, right? Because if you're in a fund or anything like that, you want to always kind of be in a position. This is kind of like I've said before, I'm a big Ray Dalio fan, and he does a lot of things like this. He talks about inverse correlations and being, spread out in the market. So with that being said, this is the logic so far. We want to make the money no matter which way it goes. If it goes up first, we want to make money no matter which way it goes, and still be in a position and not let the S&P beat us, while keeping our downside minimum and capturing downside should it free fall. So far, if it goes to supply first, we're going to kill the 300 put. Why? We're going to buy it to close for cheaper than the credit we received up front. So that is the riskiest leg, and that is the first one that has to go. Then, if that happens, if the 269 falls, if the 300 put comes up to supply first and it gets removed, once it comes down to demand, we're allowed to both take profit on the 269 that we originally created and the 263, because we're more concerned with not missing up moves. We can kill both, so we can kill both puts that we bought if it drops and it bases and it keeps on going. And there's a whole, as far as corrections go, there's very specific parameters as to why they actually didn't even last that long. And I was reading, don't quote me on this, but I think it was the Motley Fool. I forgot the writer, but a very few amount of corrections even last for more than like 100. And so there's the part, don't quote me, like 125, 145 days. So if we're buying options that are at least 3 months out, and if it's in demand, the likelihood of it coming back up is really, really, really high. If it's in no man's land, like right now it's kind of diddling in the middle, it could be 6 months or so on and so forth. So that's when you kind of play with the time frames or when the expirations. With that being said, with that aside, my point for saying it that is that if it goes to supply first and then it drops in its basis, I would be okay with killing both puts that we bought as they're coming and making a lot of money, because we're not likely going to have it be down there all that much. Now again, it's got to be like on the highest time frame, demand and basing. So if it's on a smaller time frame, I wouldn't do that. But my point is, because the 300, which is the biggest risk, has now been released, that 269 is allowed to go as well. Now at that point, we'll be holding on to a 283, would be the bookmark or the benchmark that would be keeping us in the trade to make sure the S&P doesn't take off without us. And for the purposes of that, we would have to hold it for the duration of the year. So I think we bought it forward in time. Now, inversely, if it free falls first, we're not allowed to sell the 269 put because it is married to the 300 put that we sold. So then that 300 put would be essentially for lack of a better term, kind of naked if we were to release the 269 put first, which is why we bought that 263, because if the market falls first, we're allowed to release the 263. One is cheaper to buy than the 269. It's still within the current price and demand area and is not married to anything. So we're allowed to just kind of release it and not have any margin implications to the accounts or any higher risk to the account. At which point, if that happened and then it came back to supply, you are allowed to then sell the 300 put. And now having captured the down move that just happened that cost you to close 263, and now making profit on the 300 put if you buy it to close at a price higher than current price. At which point you would have released all of your legs, holding then now only to the call that is intended to be held through the entire duration of the position, because you don't want to miss the up move. So that is the last leg that is holding on to the up move. Now, on the second portion, I'm going to try and see if I can get this trade and show you guys how leg by leg we'll make money as I go forward. Okay guys, so here are the results from my actual P&L, my actual trading account. I only did a single contract just to show for demonstration. Again, this is not something that I was necessarily a style I was trying to trade. This is a model I was making. So as you can see here, the 269 put, so the only one that lost money was the 263 puts, and that lost $3.34. So you can see here that 269 put was bought for $479. So that is the debit that I paid for, and then was sold to close for $679, so making a profit of $198. And that happened on the 29th, on 5/29. So 5/29, let's see here. So it must have been, oh my gosh, there. So it must have been right around here somewhere. 29. So as you can see, price came down and it was a lower, it was a higher low, so that's why I deemed it to be a bull market, releasing then the 269. Like I said before, that this one couldn't really be released without this one getting let go first, or at least one of the two puts getting let go first. So the 300 put here made $154. Yep. And then the 283 call made $170. So in total, this trade made, so yeah, the total that this position made was $518 with 29 cents. Now, mind you guys, this was only about a $200 margin per contract to trade, because the only risk was those $2 in between break even and where the put was then picking up the possible losses, the difference between the break even of the 300 and the 269. So right around that price were those kind of miss each other. That was the maximum risk. So it was a very small margin to make $518. So if you wanted to buy 10 of these contracts, it would cost you, $2,000. 100 would be, $20,000. And the risk reward here, not only is it quite well margin considered and how little the risk is, but you're essentially making and banking on making money no matter which side breaks out first. So I know something that I had shown in my Facebook accounts or somewhere else is kind of what a beta hedge, or like what my positions would do if all my positions turn against me. So here you can see that in this test account of only $16,500, if the underlying positions went 30% in my favor, so my account would make $61,000 if the positions I was in went 30% in my favor. If the positions I was wrong and they turned against me by 30%, I would still make $26,000. So I roughly would make, well over 4 or 5 times my principal if it went in my favor at 30%. And I would at least make about 30% or so on a drawdown, or if it turned against me, I would still make about 30% on the account. So it's not so much magically. This is very, very well formulated for this purpose. So when my purpose was to make models like this is what I would do. Now, I usually, like I said, trade directionally, and then it's much more simple. I'm usually just directionally trading based off of supply and demand. But I pretty much wanted to make this video just to kind of give you guys the explanation rundown of a trade like this. And from what I understand, it wasn't really explained, because obviously it would take a long time to explain something like this. But I wanted to make a video kind of highlighting the positions, what happened thereafter, and basically the logic behind a trade like this. Obviously, the legs were meant to be released one by one, so it is a leading indicator on top of a leading indicator on top of a third leading indicator, which is kind of banking which side is going to go and break to and from first. So we're basically taking a leading indicator, which is supply and demand, and then putting two multiples on top of that. And this is where the Greeks matter, in my opinion. Is once you know price action and what your break-evens are, then the Greeks can use to measure what leg has more in value in time decay versus volatility. And that's where, I don't know where some of the delta rules come from. Buying an in the money call, depending on how you do it. Right now is January. It's early January. It is January 13th. So if you had bought an Apple call that, if you bought the Apple 200 call that was worth at least $22 when Apple was at its all-time highs, once that call free falls, or once Apple free fell now to whatever it is now, 2 or 157 or 153 or something like that, you just lost those $30 that it was in the money. So even though it sounds less risky a lot of times to buy the in the money call, you can lose an exponential amount of more money depending on what's going on. So that's why you have to know price action and what your goals are. I'm a big believer in knowing the rules, memorizing the rules, and then memorize to forget them so that you're not thinking about them. And then once you understand the rules and you understand what you're trying to create, and you're trying to understand, and what you're trying to create out of those rules, and you have the end goal in mind, you can reverse engineer and understand the consciousness by which the rules that you subscribe to live by, and you understand the consciousness behind the framework of the rules to which you subscribe to. So the challenge with just going off of purely rules-based, very often, or more often than not, is that if you're limiting your entire trading system based on someone's rules, then the most you'll ever be able to accomplish is the capacity of the person that made those rules. And for me, at the risk of sounding extremely arrogant, I subscribe to the idea that I know better, or I will figure out better than someone else until proven otherwise. So the fatal flaw in just purely rules-based strategy, if you don't, you can make a lot of money just doing that, but you don't allow yourself to explore the consciousness in which the rules live by. So you will never beat the person or outperform the person that created those rules. And thus you fall victim to someone whose P&Ls you may not even know, for that matter. So hopefully this was helpful conceptually to understand kind of what the logic was there. And these are the results. And hopefully you guys found this video informational. Let me know in the comments below, or like, subscribe. Feel free to message me. Again, I don't really intend on teaching price action. Is not for me to teach, or at least not supply and demand. It belongs to TA and Sam Seiden. But conceptually, I figured I'd explain this kind of trade, and then hopefully you guys find it beneficial. So Anyway, guys, I hope you have a fantastic rest of your day and happy trading.